It's an environmental, social and corporate governance reporting platform, ESG. We're proud to be supporters of the RIU conference, and I'd firstly like to start by congratulating Social Suite customers that are here presenting throughout the duration of the conference. Black Canyon, Coda Minerals, Gallon Lithium, Galileo Mining, Helix Resources, International Graphite and Nordic Nickel. These companies, along with 80 ASX micro to small caps, understand the importance of ESG to create long-term organisational value. The Social Suite platform is specifically designed for micro to small caps in supporting them, one, to attract capital from investors that value ESG disclosures. Two, creating revenue through responding to supply chain requests and the negotiation of offtake agreements. Three, mitigating organisational risk while building brand value. The Social Suite platform is easy and affordable for the smallest of organisations to get started with ESG. This is complemented by our industry expert ESG coaches who will help you with your ESG journey. We wish all companies and investors a successful RIU conference, and we're here to help with your ESG needs.
Welcome back to the post-lunch session on at the conference. Luke Mortimer is a geologist with over 30 years experience in exploration and mining. exploring for a range of commodities, including copper, nickel, zinc, gold, and lithium. Luke also has valuable underground mining experience at WMC's, now BHP, world-class Olympic Dam, and Perseverance Mines in Australia. Over years, he has successfully implemented and managed numerous multi-million-dollar grassroots exploration programs worldwide. Luke has significant tertiary qualifications in geology. Please make him welcome Luke Mortimer.
Thank you very much. It's my pleasure to be here this afternoon to give you an update on Kalamazoo's latest developments. There's the usual forward-looking statement. So this afternoon, in the short time that I have, I'm going to be covering Kalamazoo's major gold and lithium assets, starting with our Pilbara gold projects, particularly the Ashburton Gold Project. We have announced just last week a resource update of 1.44 million ounces at a very healthy 2.8 grams per tonne. Importantly, the bulk of that is actually the Mount Olympus deposit, which makes up about 1.1 million ounces, where the grade there is increased by 24% to 2.7 grams per tonne. I'll also touch on our exciting Melina West Gold Project, which is in the same structural corridor along strike from De Grey's Hemi discovery. I'll also be covering our Central Victorian gold projects, where we continue to consolidate our ground there. We're a major holder of exploration tenure in Central Victoria in both the Bendigo and Melbourne zones. We recently acquired nearly something like 1,500 square kilometres of the Mount Piper Gold Project, located near Fosterville and in between the operating Costerfield gold mine and the exciting Sunday Creek discovery by Southern Cross Gold. And also we continue to explore in the Castlemaine and Malden goldfields, which have impressive historical production numbers of multi-million ounces. We also have significant lithium projects in the Pilbara, as well as in the Lachlan Fold Belt of New South Wales and Victoria. We have a significant joint venture with SQM, one of the world's largest lithium producers at Doms Hill and Marble Bar project. Where recently at Marble Bar, we have discovered some spodumene-bearing pegmatite dikes. These have some high-grade rock chip values up to 2.8% lithium oxide. In the Lachlan Fold Belt of southern New South Wales and northeastern Victoria, this is a newly emerging lithium province. We've taken out a significant amount of early mover tenure there, and that's very exciting for us. In terms of our license to operate, we're actually the first junior gold and lithium explorer to be fully credited under the federal government's Climate Active program as carbon neutral. We are carbon neutral for 2022, and that is an ongoing commitment. And we have that also strong commitment to our Indigenous stakeholders, our approach to HSEC and corporate governance. The main takeaway points from this slide is really that our share register is very tightly held, and the top 5 shareholders actually hold about 50% of the stock. So moving on to the Ashburton Gold Project. Last week, I think it was, we announced our first independent resource estimate for the project, which now stands at 16.2 million tonnes at a very healthy 2.8 grams per tonne for a total of 1.44 million ounces. Importantly, we had a 10% increase in the grade to 2.8 grams per tonne overall. Just as important, 68% increase of that resource went from inferred into the indicated category, which was actually a reflection of the thoroughness and robustness of the approach that was taken to the resource estimation by CSA. And that all up to something like 11,500 drill holes in there. The other important thing to note is that the grade at the Mount Olympus deposit increased by 24% to 2.7 grams per tonne. And that's important because 75% or the bulk of this resource is actually at Mount Olympus. We also have identified an additional midpoint exploration target underneath the current open pit resource at Mount Olympus of 170,000 ounces, There are some drill hole intercepts in there, and we'll be following that up. I think it's noteworthy that when you compare to our other Pilbara peers, the Ashburton project is a standout purely on its grade at 2.8 grams per tonne, which is extremely healthy. In the background, we've been doing preliminary economic and development studies. This new resource estimate has now given us the confidence to pursue those studies further. This is just a quick video, a flyby of the Mount Olympus pit. I'm sure you'll agree that's a nice looking hole in the ground. We have an existing camp there. It's not too far from Paraburdoo, so there's plenty of and Newman. There's plenty of close by infrastructure, and it was already previously mined by at least the oxide part by SEPA quite a while ago. Moving on to the Melina West Gold Project. It's as I said, it's on the same structural corridor along strike from De Grey's world-class Hemi discovery. There we've completed a lot of detailed ultrafine soil sampling across the bulk of the tenements there. Using that in the existing airborne geophysical surveys, we've identified at least 5 exciting, highly prospective targets. Last year, we managed to get a small RC drill program in. It was our first one there. Unfortunately, we did have to bunk out a bit early because of a heavy rainfall event. Interestingly enough, our best result was 1 metre at 10 grams per tonne. It was actually at the bottom of the hole. It's the last sample. It's open in all directions. It's associated with a nice looking magnetic feature, and we'll be going back to look at that and for further drilling in 2023. We have more plans to be working in this area and looking at other targets that are already fully permitted and had their cultural heritage surveys completed and are ready to go. Moving on to the Central Victorian goldfields, we've been big in the Bendigo zone for a while now. It's famous as historical production of in excess of 60 million ounces. But what's the standout there is that it's at an average of 15 grams per tonne. Obviously, the recent success story of Fosterville gold mine has reinvigorated the Victorian scene, which has, previously had been left a little bit unloved, but that's now a renewed exploration rush into Victoria. We have a strategy of consolidating over major gold fields. We've got over 2,000 square kilometres there, close to Fosterville, and we have significant exploration tenure, Castlemaine Goldfield, South Muckleford, which is the Malden Goldfield, Tarnagulla, Myrtle Creek, and the Mount Piper projects. There's very limited modern exploration in these areas, and as an example is Castlemaine. It's very shallow drilling, of an average of only 137 metres. More recently, in Victoria, we acquired the Mount Piper Gold Project. That's approximately 1,600 square kilometres. It's part of our strategy of consolidating and grabbing more tenure in Central Victoria. It's a very exciting project. It's located quite close to Fosterville. It's also sandwiched. We've got all the ground in between the operating Castlemaine gold mine, Costerfield gold mine, and the Sunday Creek and Reedy Creek projects, which have been coming up with some very exciting results. It's highly prospective for epizonal style, high-grade gold antimony deposits. We have certainly plenty of mineral occurrences like that in this tenement package. We are beginning our exploration program there this year. It's very underexplored. There's very few drill holes, and what have been done are quite shallow. We've already identified one prospect, a Goldie prospect, where previous rock chip samples were going an ounce per tonne. Moving on to our Pilbara lithium projects. Everyone knows the Pilbara is the world-class hard rock lithium terrain with the Pilgangora, Wodgina and Arch deposits. Our projects are sandwiched in there. Kalamazoo, we've got nearly something like 350 odd square kilometres of land holding at Doms Hill, Marble Bar and Pear Creek lithium projects. We're in a major joint venture with SQM, who says one of the world's largest lithium producers. We've recently identified spodumene-bearing pegmatite dikes with rock chips going up to 2.8% lithium oxide. We completed a phase 1 drilling program last year, and we're looking to do more drilling this year. Into Lachlan Fold Belt. This is a newly emerging lithium province. There is a significant bona fide occurrence of spodumene-bearing pegmatites here in the alpine terrain up here. This is the Dart mining. This is now the subject of a significant joint venture as well with SQM. We've now, as an early mover, have taken all this ground here called this Talangata project and the Jingellic project here. This is highly prospective geology. We've got the right source rocks, the right fractionated granites. We have outcropping pegmatites and lots of alluvial and hard rock, tin, tungsten, and tantalum occurrences, which are all positive indicators for LC2 mineralisation. And it's the last slide, just to highlight the major assets. We have the Ashburton Gold Project, 1.44 million ounces at 2.8 grams. We have a major joint venture with SQM, underway in the Pilbara lithium projects, significant early mover tenure in the Lachlan Fold Belt, continue to search for the next Victorian world-class discovery, and we're building on our past exploration programs. Thank you very much.
Thank you, Luke. I think I should point out that speakers going forward, which is a term I hate, going forward, but the speakers for the rest of the day, there will be 10-minute sessions rather than you having to struggle through. So 10-minute sessions. Dr. Mike Jones is the Managing Director of Impact Minerals Ltd, which takes a portfolio of battery and strategic mineral projects in Western Australia and New South Wales. Impact recently became one of 7 companies chosen globally to participate in the Explore program run by BHP, a disruptive accelerator funding venture created to help accelerate exploration for critical metals. Please welcome the accelerating Dr. Mike Jones.
Thanks, Jerry, and thanks to everyone for coming along to the graveyard session. It's been a great conference, and all credit to Stu and everyone for putting this on. It's showing how the industry is very vibrant and how well we're doing. So yes, most of you probably heard about the BHP Explore program. I thought I'd just give a few slides, and so my talk will be a bit more technical today than I normally present, just to show you how we got onto the program and the type of work that we're going to do as part of this program. So BHP basically recognised they're not getting access to enough projects to supply the copper and nickel in particular for the energy transition that we're going to go through. And they think in terms of decades. So they're thinking, where are we going to be in 2050? And so they came out with this Explore program, which is basically concepts from accelerator and incubator programs used in the tech space and also in venture capital, and looked at how they might apply that in the junior mining space, and came up with this Explore program. And having been involved in it within the last couple of months, it's really quite amazing, you know, what they have done and what they're trying to achieve with this particular program. Often with the big companies, and we've all dealt with them, very difficult to deal with them. They're slow and lumbering. They created a new division called Explore, which is very nimble, very agile, and they're funded to do their own work and their own investment decisions without having to go up the ladder. And so the speed at which this has occurred has been quite amazing. But not only are they giving us funding, and they've given us $500,000 over 6 months to push forward our concepts for Broken Hill, they've put together what can only really be described as a business coaching course for junior explorers to work with BHP, covering everything from business strategy, mineral systems, how to communicate, how to engage with your stakeholders, the indigenous groups, and also business chemistry, how your people interact with each other. And we sort of say, oh, people said, oh, BHP indoctrination. But if you want a long-term partnership with a major, you need to speak their language. And that's what this program is all about. And so if you're an MD of a junior company and think that you've learned everything you need to know, A, you shouldn't be the managing director, and B, you should definitely go on this program. So it's been quite amazing, and Deloitte's have been heavily involved, and he actually gave us, the head of Deloitte's global strategy gave us an introduction to the strategy they use. And there's a sort of 5 cascading things in their strategy. What's your winning aspiration? Really, what's your goal? Where are you going to play? What work are you going to do? How are we going to win to actually discover what we're going to do? And what capabilities and management systems do you need? And so very much down here, this is what BHP are doing. We've gone to them with concepts about where we're going to play. And as the seven cohorts, as we call ourselves, are in there. And we went to them with this concept. This was our winning aspiration. What happens if there was 100 million tons of copper at Broken Hill? Sounds amazing, considering there's not many not much evidence of copper at Broken Hill. But don't bother reading all of that. But Broken Hill has been, I like to say, has been 1.1 ore bodies found in 140 years of exploration. But in the last 30 years, there's been very little work done because it's been done by juniors. And juniors run out of time and money very quickly, mainly because Broken Hill is actually structurally very complicated. So if Broken Hill looked like this originally, it now looks like this, all scrumpled up, and trying to understand that geometry is actually very difficult. So we went to them with 2 ideas, one idea, none of which were ours, as it turned out. And we said, look, we think that we can find these things in Broken Hill by creating a new 3-dimensional model of the area using these 2 new ideas. And so where to play? So this is the ground holding that we have in Broken Hill. I've been building up this ground for 8 years since coming across this concept. I've tried to promote it to numerous majors and mid-tier companies. Nobody was interested. BHP took a look, and within 3 months, we're on the program. So that's the speed at which they're operating, and they've got a steal on all the other majors. So this is where we're going to put the 3-dimensional model together. And what sort of seeded all of this was a very unusual rock, which I won't go into. But basically, there's some iron magnesium-rich rocks, and they seem to grade into these silica aluminium rocks, which also have lead, zinc, manganese, and phosphorus in them, which are all the alteration minerals and key minerals associated with the Broken Hill material. And it turns out there's an unusual rock type the old timers called a potobolite. And these basically look like lake sweats. And there's nothing more that exploration geologists like as a good sweat. And this is looking like in something that's sweating out of the amphibolite there and giving some of the minerals and materials. We then came across the work. Our first idea was actually Tony Crawford. He's a well-known academic and consultant. And he'd come up with some interesting things about 10 years ago, which has never really been published, but gives us a whole new framework to look at Broken Hill. This is just a stratigraphic column of the rocks that are there. Broken Hill sort of sits in the middle in through here. And most people and most research has been focused on the sediments in through here. But in fact, within that sequence, there are a whole lot of these iron and magnesium-rich rocks, the gabbros, and you've heard all about that are intruded along through here. And it turns out they're actually volumetrically very significant. And they do 2 things. They add an incredible amount of heat to the system. And secondly, they have the potential to add to the metal budget there. And people have basically ignored these for 140 years. So the other thing about these particular ones is that close to Broken Hill itself, the line of lode, which I should have pointed out is a 300 million ton ore body. It's one of the world's great ore bodies, silver, lead, and zinc. Turns out that they're actually very iron rich. They're very unusually iron rich on a global scale. And what happens to those rocks is that as they crystallize and cool down at a particular point in time, you basically get an unmixing, almost like oil and water. And what it does is spit out a silica and aluminium rich thing, which looks remarkably like the rock I showed you, and these potobolites, which is a term that the old timers used to use. So we believe that we found field evidence for this sort of process to be going on. And that's what we presented. And so the corollary of all of this is that if these mafic iron magnesium rich rocks here were responsible for some or all of the material at Broken Hill, there's been 28 million tons of lead mined to date at Broken Hill. It's a necessity of the igneous system that it had the potential to carry at least 100 million tons of copper. And the question is, where is that? And the answer is it's not at surface, it's going to be at depth, or it might have been eroded away. So the question is, how do we work out where that is? And that brought us to a second idea, again done by Tony, is that these unusual, these amphibolites, these mafic sills, as they crystallize and cool down, it turns out that the dense materials go to the bottom and the light materials go to the top. And it tells you which way up that unit was. Now, because of all the deformation and alteration that's gone on in Broken Hill, because it looks like this, the rocks in between have generally lost all evidence of which way they were up. So that makes it very difficult to unravel it. But amazingly enough, it turns out that at Broken Hill, these igneous trends that we see are beautifully preserved. And this is a cross-section of the Broken Hill ore body, the work that Tony did. And he showed definitively that this is actually facing this way. and that Broken Hill lies in the core of a major regional syncline in through here. So that was a breakthrough. And then one of our prospects that we drilled in 2015, this is how long this story's been going on for, we found 2 layer parallel amphibolite sills. We just looked very simply at the magnesium and found out very clearly that it was actually a fold, it was a syncline in through here, and it's all working, and they're in iron-rich dolerites. So what that's given us is a mechanism, and this is a regional magnetic map, and this is probably about 20 kilometers through here, and we own most of the ground in through here. There's some very strongly deformed rocks in through here, fold interference patterns we call them. And so with these amphibolites now, we can actually go along, and Martin, my geologist, is going to be going there next week, and we can work out which way they're folding, and we can actually hopefully unfold it and work out which way up they are. So, and the reason behind that is actually evidence that we got more from our Dora East project. Is this moving? Yeah, there we go. This is a cross section. This is about probably 200 meters through here. Again, we drilled most of these holes 2015, and we find high-grade silver lead zinc at the top of this amphibolite, and we found high-grade narrow zones of copper in shear zones at the base of it. There's a 0.7 meters, doesn't sound much, but it's 2.4% copper and 22 grams silver, and that's what we're looking for. And if you unfold this, you end up with a structure that you can trace and track. And so we really feel that we can make some amazing advances for the first time in a long time in terms of the structural unraveling of Broken Hill and where the copper might lie. So next down here, and it turns out that the Deloitte's guide, most of the strategies actually fail down here. We have an amazingly capable team, obviously myself into here, Frank Beerline, non-executive director, done a lot of work on the alteration and unfolding of Broken Hill himself. By coincidence, we have Tony, and I have a very young team, Martin, Harry, and George. Martin's the technical lead on the project. It's the 2 of us that are on the Explore program, and he's doing an amazing job. And the other thing is that a business is defined by its systems, and the Explore program is really all about Broken Hill BHP, giving us those systems in order to be able to work with them and go from there. So Impact Minerals was set up to look for world-class ore bodies. Anything less than that is not really worth that. And so I thought I'd just do one little bit of history, because we're always working on different concepts. And I don't say things lightly. Watch this space. We're working on a few things going forward. And if Jerry will indulge me, this is a bit of history. The first video I ever did from 2007 when I first presented here. And just to keep you awake in the afternoon. So we called Impact because our first project was at Meekatharra, and there's the Yarrabubba impact structure for those of you who are familiar with it. And there should be some sound with this, but it's not coming out. Some people will say this is why Meekatharra looks like it does, but turned out that so the big meteorite impact structure, we did a magnetic survey and discovered one of the largest sort of magnetite destructive things. We were looking for nickel copper. We did find nickel copper. It was about the size of my fingernail. And so we had to move on from there. And we're now at Broken Hill, looking to finally make an impact. And this is the year that you should keep your eye on us. Thank you very much.
Mike Jones, who had a hand in killing off the dinosaurs. Chris Reed is Managing Director of Neometals. He has over 30 years experience in the mining industry, including more than 20 in senior executive roles. He founded Reed Resources, now Neometals, in 2001, and is, as I said, Managing Director and CEO. He holds a Bachelor of Commerce from the University of Notre Dame and a graduate certificate in mineral economics from WS School of Mines. He's a member of ALZIM and is a past vice president of AMEC. Please welcome Chris Reed.
Thank you very much for the invitation. Thanks to Vertical Events and thanks to Canaccord for sponsoring it. Today, I'm going to give you a bit of a glimpse into the future and what's happening in the Northern Hemisphere and tell you about our green battery materials business. The disclaimer, really, you should just consult a licensed investment advisor. So Neometals is an emerging sustainable battery materials producer. We're producing nickel and cobalt oxide products at the moment that we're selling. We've got 3 business units. We've sort of pivoted away from the mining into more materials recovery and recycling. One of the beautiful things about that is you absolve it of its carbon sins from mining it. So we can deliver materials with the lowest carbon footprint, given that they're very, very high grade. When they go into a lot of these batteries, we get low costs. We've invented all of our processes either by ourselves or with our partners. And we've got a pretty good portfolio. So the core battery materials business today, I'll concentrate on the lithium battery recycling, but we also have vanadium recovery from the world's highest grade slag stockpiles and a lithium chemical technology for brines and hard rocks that we've developed over the last 10 years with MinRes. There's about 35 of us at the company, 5 non-executive directors and myself. So corporate dashboard, we're not immune. It's been a bit of a rough year for developers, and if you're not at steady state cash flow, but we have reached almost $2 in the last year, so that's good. We've currently got about 70 million in cash, no investments. The founders, board and management are the largest shareholders in the company. So we own 50% of the battery recycling business. Originally, we owned 100% of the technology. We've vested 50% of that with our German co-owner. We're developing that in a business called Primobius GmbH. So our aim is to be the leading provider of recycling solutions to the OEMs, be they car makers or cell makers. What is an immutable fact is more of the cars are becoming electric. As we make more cells for those cars, there's more production scrap as they get to the end of the life. We model 10 years. There will be a tsunami in terms of the number of batteries coming back that need to be recycled. Recycling is compulsory in the EU. So what we've developed is plants that can process the scrap out of the typical 35 gigawatt hour gigafactory. That's our 50 tonne a day or 20,000 tonne per year plant. That's at a feasibility study level. And the 500 tonne a day plant is at the pre-feasibility level. We don't anticipate needing to deploy them until the end of the decade. So what's driving our business is the European battery regulations that will come into effect in 2026. So we developed this process in 2017, when we were still at Mount Marion. We wanted to get actually to the other end because I'll run you through the economics, but it's just unbelievably compelling. So, what we've got to do for our plants and our processes, we've got to reach like 90% nickel, copper, cobalt recoveries, 35% lithium in 2020, and then 2026, and then in 2030, it's got to be 95% and 75% for lithium. So we're constantly evolving and improving our technology. We're not there yet, but we can't find a peer that has numbers like us, which is good. So that's what we've got to get to. We've already obviously passed lithium, which is the hardest one to recover because we do have some pretty good lithium skills. What the car makers and cell makers are faced with is that below the line, they have to declare the carbon footprint, the recycled content declarations, then there's minimum recycled content in 2030, and then they're doubling it by 2035. And so this is why you find the likes of Glencore getting into recycling and these big mining companies wanting to get into recycling because you have to close the loop. So at a very, very high level, we deliver the lowest cost materials, right? So 79% of the cost of a cell is the raw materials, right? So this is the nickel, the cobalt, the copper. So if I've got a ton of these batteries, NMC 811, which is what they aspire to produce in the coming years, it's the same as having a ton of ore in front of a concentrator that's 15% nickel, 15% copper, 2% cobalt, and 2% lithium. And at our operation in Germany now, we get paid to take that, right? It's unbelievable. So we developed this process that gives them back nickel sulfate, copper sulfate, cobalt sulfate, lithium carbonate in whatever form they ultimately want it, and copper foils. So we give them the lowest cost, and we can create these secure raw material supply chain. Like you talk to anyone in lithium, they're okay, so we're going to have all these cars, we're going to have all these batteries, where are we going to get the lithium? All the hard rock mines and all the brines that are currently in production can get us sort of halfway there. I don't know where the rest comes from. What I can say is that by 2040, recycling will be the largest contributor to the lithium supply chain. And we're heading into deficits for nickel, cobalt, and lithium in the not too distant future. So we allow them to capture, like the car makers are going to want their batteries back to put into new ones. They've never had to worry about the fuel. Now they have to worry about the fuel. And we deliver them the greenest materials. So, you know, for us, we have to measure our carbon because these guys have got to put carbon stickers on the sticker. So if they're any miner that doesn't know what their carbon footprint, you won't be selling to the car makers because then they can't tell people how much carbon's in the battery. So the EVs are typically twice as carbon intense when you roll off the production line. That's because of the batteries, and that's because the battery materials come from Australia, Chile, Argentina, the Congo, places like that. So our process, just the data, our carbon footprint off our pilot plant, and we're improving it, rips out more than 80% of the carbon footprint. So we don't model getting premiums for our product, but we will. So our patent pending solution, we have a so the front part of the plant, we can take modules or cells from the car makers. The front bit's a new addition. So we shred it up just like a concentrator and physically recover the plastics, the steel casings, the metal foils. At the moment, we're selling that black mass and getting paid for the nickel and cobalt in content. We have at a demonstration scale, the refinery hub that we're going to scale up. So we're producing nickel, cobalt, manganese, the lithium, we can produce it in whatever they want. The carbon won't digest, right? I mean, this graphite won't digest in sulfuric acid, so we sell that back for traditional uses. And one of the revolutionary bits in our process is for pH adjustment, we use ammonia, right? So our tailings is ammonium sulfate, which is a fertilizer product. So we made the finals of the German National Sustainability Award in 2022, and we won the best technology on the London Stock Exchange in 2022. So we've got a fully certified disposal service at Hillgrove in Germany, which is out of Frankfurt. And we are providing disposal services to every German OEM supply chain. So that's what it looks like. Hillgrove, which is our partner, SMS Group. So SMS are a 140-year-old German plant builder, 14,500 employees in 95 sites around the world. Production headquarters, manufacturing headquarters in Germany, but capabilities in the US, India, and China. So they'll build whatever plant we needed. So we're never worried about the feed because we know these batteries wear out. Just look at your phones, look at your cars, they wear out, you've got to throw them out. And now recycling is compulsory. So the one in the middle there, that's our shredding operation that can do 1 ton an hour. Under our license, we can't process more than 10 tons of batteries a day. And then the hydromet is on the far right-hand side. So we run trials. So the car makers are like, oh, this is great. I want you to be our solution provider. So, but you've got to make sure that you can prove that we can meet the hurdles and we get everything back and we measure and audit. It's pretty tough. So that's one part of the business. The other part is our flexible business model. So we say to these guys, you're going to have volumes over time that are going to match the general market. So what we can do is in the early stages, we can do this for a fee. And we've been doing that for the German car makers. When they go and build their own cell plants, which they're doing now, they'll have production scrap. And we're saying, well, look, we're happy to put in and share those economics and do a joint venture. Ultimately, for the big 500 ton a day plants, they're plus $1 billion. We don't want to tie up that sort of market, that sort of cash. So we will do plant supply and technology licenses. We have a number of technology licenses out there. 10% gross sales royalties, the pleasure of doing business with us. So our commercial pipeline, we've got a 10-ton operation in Germany. We're going to put a 10-ton integrated shredder and refinery in for Mercedes-Benz, then Steel Company of Canada mid-year, then look at putting our own plant into Germany. So we really want to do it and aggressive market share in Europe. Europe, by the end of 2030, there's going to be 600 billion euros worth of recoverable material, right? That's $1 billion Aussie dollars. That's 300 million ounces at 4 to 5 ounces a ton lying on the surface. So great opportunity. We're partnered with Mercedes-Benz. We've got a 5-year deal with them, building them a plant. We'll teach them how to operate and then we'll provide them with an industrial solution. Stelco, you'll just have to list this later because Jerry's going to start ringing bells, or do I get another minute? Anyway, this is the good bit to leave it on. So at the moment, if we're doing NMC 811, we get about $3,200 in recovered value for the nickel and cobalt, and we get paid to take it, which is great. But when we put the refinery on the back end, that jumps up to more than 13,000 a tonne. And we'll have all of those engineering cost study, OPEX, CAPEX out in the June quarter. So we're a fantastic catalyst-rich year. So delivering Mercedes, Stelco, starting to construct and economics. So everything you could want. Thank you very much.
Thank you, Chris. Brendan Cummins has over 25 years' experience as both a mine and exploration geologist. The majority of his experience has been in exploration geology, resource definition, and project evaluation across precious metal, base metal, iron ore, and industrial mineral projects throughout Australia and overseas. He's also currently technical director at Westoria Capital and chief geologist at Strandline Resources. Please make him welcome, Brendan Cummins.
Yeah, thank you, Jerry. Good to be back here again at RIU 2023. I was here last year, and what I really want to talk about is manganese and where its utilisation is currently going, and just recapping a big year that we've had in 2022 and what we're going to do in 2023. Just a scoping study cautionary statement. I'm going to be talking about a scoping study that we did complete last year as well. So just to know, it's plus or minus 35% accuracy. So just a little bit about Black Canyon. We listed 2021, May 2021. It's a pretty tight capital structure. You can see there's nearly 52 million shares on issue. Market cap's pretty modest at 12.7. We've got 2 in the bank at the moment. So in terms of board, we've got a really technical board, 2 geologists, 1 geophysicist, and an accountant as well who keeps us out of trouble. So look, the shareholding is very tight. You know, management and board 12% of the company, and 15% is now owned by small caps as well. So we've really traded in that 20 to 30 cent range, and for a 21 vintage IPO, that's actually quite good, I think. So Black Canyon, we had a really big year last year, 2022. And when I sort of cast my mind back to where I was presenting last year, we'd only just drilled our first holes into the deposit at Flanagan Bore. So since then, we've really moved things along. We've kicked a lot of goals, and I think we're really batting above the average in terms of what we've achieved in the last 12 months. So just quickly, we announced the discovery of FB3 in February. Really rapidly went on to deliver a resource, 104 million tonnes at 10.4. Did a small cap raise at that time as well. Did more drilling again, and then met test work started on the core that we drilled the previous summer. Put out a positive scoping study in August, and that showed the metrics of the projects, which were quite encouraging. And then we really got into the battery side of things with manganese sulfate. So we were looking at making, you know, a cathode active material, manganese sulfate, that feeds into that sector. Did a resource upgrade as well, just to spice things up a bit, 171 million tonnes now at 10.3, and really got stuck into more detailed metallurgical test work, which was put in sort of in October, and we've been working through that now. So we're really running a twin stream, looking at making manganese concentrate for the steel industry, which is the bread and butter, but then also looking at manganese sulfate for the battery industry as well. So December, finally we could hang up the hammer for the break, and we had things in the lab ready to go. But one last thing we did was put in a mining license application just to keep things moving. So kicking off environmental studies on that. So what's in store for 2023? I thought I'd jump into the end at the start. We'll continue our hydrometallurgical studies into making manganese sulfate, and that's been quite encouraging so far. Looking at a scoping study at how that might look in terms of economics and where we might place that into the market. But not forgetting the manganese concentrate going into the steel industry, that's a big part of what we do. So we're working that through the lab now, and hopefully in the next month or so, we should have some results out on how we've been able to achieve a really good quality manganese concentrate. Ongoing feasibility test work at the same time, which will go through for the rest of the year and into next year when we start more detailed engineering and logistics studies as well. So in parallel, the environment and approvals is really important, and doing our heritage work as well. And that's all part of, once you lodge that mining license, everything like that has to kick in. So we do need to get on top of those approvals. But we do have 2,500 square k's of tenure up there in the Pilbara, so I'm not ever going to lose sight of exploration. I'm a geologist. I love to getting out there doing that. So we will be spending time and looking at that ground and seeing if we can find some potentially smaller, high-grade deposits. We've got 100 million tonnes already at 10.3%, but can we find something that's a little bit smaller in size at decent grade as well? So manganese. I don't know if anyone's spoken about manganese so far in the conference, so I just want to give you a bit of insight into what manganese is all about. So manganese is the fourth most consumed metal in the world. 20 million tonne per annum is shipped around and utilised, and it's used mostly in steel. So 90% of that goes into steel. So it's added into the steel to reduce corrosion, increase hardenability, and so tonne of steel has about 10 kilos of manganese in it if you sort of understand the size and how much is used. So baseload demand for manganese comes out of China. China produces, I've got 870 million tonnes of steel per annum. Globally, it's 2 billion tonnes per annum. So manganese is always going to be needed in steel. It's just not replaceable. So we do see that as our bread and butter, and we want to develop a mine up there at Flanagan Bore. But what really is changing is the demand for manganese sulfate feeding into batteries. And the graph on the right-hand side does tell a bit of a story. You can see it, but you can see manganese demand increasing about 9 times as opposed to the rest of them, which are about 6 times. So, and that's a function of the changing in the chemistries of a lot of these batteries. So NMC batteries have been the go-to battery, but there are a lot more technologies coming out, which I'll go into. And I love reading about this stuff. You get sort of hooked in just before you go to bed, and you start getting on some data, and you can read about different battery companies now looking at modifying the chemistry of their batteries and when they're going to go in production. I'm just thinking, how are we going to get involved in that? So look, it's a really dynamic space, and I've talked about cattle and asphalt and Umicore in this presentation. That's happened in the last 6 months. So it is moving, and it is moving more towards a cheaper battery, and manganese is a solution for that. So there's also the issue of supply, and diversification of supply is looming large. And you can see from the bottom pie charts that China dominates this area, and it does that as well in rare earths and some of the other battery components and lithium. So I guess the thesis is that the US need to replicate this whole supply chain in the US, and that's the opportunity for companies like Black Canyon to get involved in that, particularly with the Inflation Reduction Act. So we have done some preliminary work on producing manganese sulfate, and this is a bit of a summary of that. We've been able to show good extraction rates from there. We can produce a high purity manganese sulfate. It's not battery grade yet, but we are working towards producing the battery grade manganese sulfate. So hopefully that'll be happening in the next 2 to 3 months, and that's what we'll base a scoping study on. We're also looking at expanded high purity manganese sulfate. So we've got so much ground in the Pilbara. So what we are doing is looking at a number of different deposits and seeing if there are better deposits that leach and produce manganese sulfate as opposed to some of the other deposits we have. And with that, we might be able to look at commencing a quick start, a project that is just a simple mining, crushing, scrubbing type operation. Should be relatively easy to approve as opposed to Flanagan Bore, which will be the backstop, which will go on for 20 years. In terms of the portfolio, 2,500 square kilometres up there in the Pilbara, ranging all the way from Newman all the way up to Woody, which is a 50-year-old mine, looking for both hydrothermal manganese and also shale-hosted manganese. This is Flanagan Bore, so 170 million tonnes there, at 10.3% manganese. Because it's a fantastic deposit. It's big, it's uniform. There is a high-grade zone in there as well, which is 40 million tonnes at 13%. So I'm really happy with that discovery. It's good to have that one under our belts, from the get-go, and it has made life a bit easier for us to continue, developing the company. The scoping study results as well, so 134 million NPV, 67% IRR, 20-year mine life, 1.8 million tonne throughput, producing about 500,000 tonnes of concentrate per annum. And the capex is only 44 million, so go and fund it this weekend, really, if we had to. This is what it looks like in the ground, shale-hosted manganese. So you can see the bands of the shiny stuff there. That's in the upper photo. They're sort of 5 to 10 millimetre thicknesses. In the middle slide, they're about 100 millimetre slugs of manganese, and you can see the same in there before. So the preliminary work we've done has shown that we are able to produce a 30% plus concentrate, but we are doing more detailed pre-feasibility level metallurgical test work to really be able to produce, using a dense media separation process, a consistent plus 30% manganese concentrate. So really, we are ticking the circles in terms of manganese concentrate feasibility study, and also in parallel a high purity manganese sulfate study as well for the EV batteries. It's the Explorers Conference, so I'd be a bit amiss not to talk about some of the exploration ground as well. And a picture paints 1,000 words, and there is a lot of manganese in the district. It's a well-known manganese district, so we've got plenty of other projects that we need to get onto as well. And I'm just showing some of the highlights there. We've got shale-hosted manganese, which is some of the pictures there at Davis Creek, but also some hydrothermal mineralisation there at Hurricane. So yeah, we've got our work cut out for us in the next 12 months. Why invest in Black Canyon? We're all about manganese. We're not looking at multi-commodities, well-funded, tight capital structure. We've delivered results. We've shown that over the past 12 months. In fact, I think we've over-delivered, but that's my personal view. And next year is looking the same in terms of continuing the studies and de-risking the projects, and ultimately looking to get some partnerships as well in terms of offtake and end user involvement. That's it. I'd say come to the booth and see me, but I'm going to be packing that up in about 10 minutes. So feel free to reach out and love to talk. Thank you.
McGarry, who thinks about geology as he's going to sleep at night. Sorry, Brendan Cummins, that is. Graham McGarry probably does the same thing because he's executive chairman and managing director of Beacon Minerals, owner of 800,000 ton processing facility at Jardie in West Kalgoorlie. Beacon has paid dividends to shareholders totaling 37.8 million in FY21 and FY22. And Beacon have recently acquired a 19.8% shareholding in Maximus Resources Ltd, a gold nickel explorer with prospective ground holdings in the Spargoville area south of Kalgoorlie. Please welcome Graham.
Thank you for that. Beacon would like to thank Gavin Waits of Canaccord, Stewie McDonald, Sham, Andrew and the staff of RIU for their support and the opportunity to present here today. Beacon's a modest gold producer, 70 kilometres northwest of Kalgoorlie, quite a famous town, obviously. Standard disclaimer, which you've all read many times. Beacon signed an option agreement with Prospector in January 2017, and our first gold was poured in September 2019, a period of 2 years and 9 months from signing the option agreement. We've had steady gold production, no big rises or falls. We have just revised our guidance for financial year 23 to the upper end, 27 to 30,000 ounces. So we are a modest producer, but we're a profitable producer. The December quarter, panel 4, the lower grade was planned. It was the lowest grade section of the whole ore body. And our production was at the as low as it's been since we started, despite the high throughput. As was mentioned, since March 21, we've paid dividends of plus $37 million. The directors and staff own plus 20% of the company, so there's a fair bit of skin in the game, and I think that's important these days. Particularly, gold is probably on the nose, and therefore people who are driven by a surplus cash flow will probably succeed through this tough time. As I mentioned, the grade was low in this quarter, but full year, calendar year 23, the ore will come from panel 3, and that'll dominate, and therefore the guidance has been lifted. In December, we purchased the Gecko tenement for just under $8 million with a cap royalty, which will take that purchase price all up to $11 million. So we're quite comfortable with that. We're the natural owner of the Gecko mine, and I'll talk a little bit about that later. We do have a community fund, which is focused on Coolgardie. It's managed by Darren Gabe, the big fellow in the background of that photo. We also support, in a minor way, the Kalgoorlie community. And we also support the Osarura School in Timor-Leste. That's an area in Timor-Leste that we've been to. We know the area. We have a close association with the school and with the people of the surrounding community, which is known as OSU. The plant, which the photo slide shows here, is running at 850,000 tonnes per annum. Not a large plant by Goldfields standards, but it makes money, which is what we're about. The plant was basically designed by Jeff Greenwell with execution and help from several people, namely GR Engineering, Tony Petruzzi, and we appreciate the support we got. Some of this is very basic stuff, but very important. We've increased the tails capacity at the mine. Once we get approval for panels 2 and 4, which if we've finished mining, we will have plus 7 years tailings capacity, and all of the costs will be sunk by the end of June, and that's a great asset. Our bore fields have been stretched over the past 2 months with the very dry conditions, and the Gecko water, when we go to dewater the Gecko open pit, that water will be deposited into panels 2 and 4, and that will allow us to refresh our bore fields, which are really a paleo channel that's about 21 metres below the surface, quite a unique paleo channel that ultimately ends up in the Great Australian Bight. So people say, why do you make money? Well, one of the attributes of this ore body, even though it's low grade, is that there is a very low strip ratio. The strip ratio is about 2.7 of waste to 1 tonne of ore. I think this slide does just show you a couple of things. You can see this Silkred area here, that's quite hard, still has some gold in it, low grade gold. The clay area, which is a different colour here, has high grade gold, and obviously there's modest amount of tonnes there, but very high grade. It's also very boggy and also has a lot of water in it and creates some mining troubles. But we mine that with articulated trucks. The Silkred ore, we are now mining it with rigid trucks, and we have moved to an owner mining fleet. Versons and Tyco, the mining approvals have all been secured for both those projects. We bought that about 3 years ago, and we're planning to start mining there in August, September of this year, once we finish mining panel 3. It is low grade, so we will have to be on our game. That's another reason why we have gone to an complete owner mining model, and that will assist us in keeping the mining costs low, and provided we control the drill and blast and the current gold price, it'll be a profitable operation. Gecko, which is listed in the bullet points there, is not in the mine schedule yet. People do question, why did we buy it when there's been other operators have failed? The reason they had difficulties was there's high water inflows, probably up around 70 litres a second, which is quite a reasonable amount of water by Goldfields standards. Also, the poor ground conditions, there was failures of the wall, southeast wall. So we will have to plan and manage these issues to be able to be successful with the mining there. But we are also only 20 k's away from the mine, and we'll be running it through our own mills, so we won't have those cost constraints. The ore stockpiles there are quite extensive. There's different stockpiles. There's also a mineralised waste stockpile. At current gold prices, there is a possibility that those stockpiles will be quite economic. We'd like to also thank Hampton Mining Services, who's helped us transition through to our own mining fleet, and they've been a wonderful help to us, and they're a local group based in Kalgoorlie. As I mentioned, Gecko is not in the reserves yet. Black Cat is, and we will be doing more work for extensions on Black Cat. There's been at least 3 operators over the last 2 decades at Gecko, and collecting all of that data to be able to get an independent expert to sign off on the Gecko ore reserves has been a challenge, but Mining Plus have cooperated in the last couple of days, and we think that'll help us progress that exercise. The exploration at Big Cat, I've mentioned Black Cat. So we will see that progressing in this next 12 months. There'll be exploration for extensions of Black Cat, as I mentioned. At McPherson's we have been exploring and doing grade control drilling, and we will be looking for underground ore there. And I'd like to thank the input of Gary Mills has encouraged us to look at the underground possibilities at McPherson's. But the open pit there is up around McPherson's and Tycho is up around 1.9 million tonnes. There'll be follow-up drilling at Queenslander and Frank's Find. That will be part of our exploration in the next 12 months. So that has possibilities for generating more ore for us. As I mentioned, the Gecko tenements, we have now acquired 100% ownership. The transfer into our name will occur in the next few days. The mining resource estimate has been delayed for the reasons I've just explained. Several owners, probably even more than 3 over the last two decades. So Newmont were the original discoverer of the deposit. So the problems and challenges and opportunities are there. I think today we've read that the Wesfarmers are having difficulty managing the labour market in Western Australia. It's very volatile and it's only going one way, is upwards. We've acknowledged this problem and we are proactive. We don't intend to have any plant expansion at the Geordie plant. We are securing graduate professionals from Timor-Leste, and in the last day we've been advised that the first 8 will be able to be flown from Dili to Western Australia and into Kalgoorlie to commence work for us. We have strong site management with systems and procedures well established, so we're quite capable of extending our operations in the Eastern Goldfields. We've got short lines of communication to the board of directors. 2 of the directors are resident in Kalgoorlie, so the management on site has little difficulty in getting approval. The Maximus acquisition could be labelled an opportunistic acquisition, but we've been watching the ground at Spargoville for some time. It comprises mainly mining leases with a clear pathway to a public road, so it has been on our radar for some time. We've been briefed by the Managing Director, Tim Wither, and we support his strategy, which is drilling 80% of his money will be directed at gold targets and 20% will be directed at nickel targets. And that drilling will resume shortly after a corporate hiatus caused by some disruption from the previous major shareholder. We have an ultimate pathway to help MXR turn dirt into money, so that is an opportunity that's available to Maximus. Tim has also alerted us to the lithium possibilities at Spargoville, and we congratulate Tim on his patience in a very much an overheated market. So I would like to congratulate Tim to get his lithium possibilities to where they are now. Thank you very much.
West Australian-focused explorer Accelerate Resources, which trades under the code AX8, is off to a solid start with its strategy to focus on developing the Woody North high-grade manganese project in the Pilbara. Accelerate's founder and managing director is Yaxi Zhan, began her mining career with the Sino-Steel iron ore project in WA about 16 years ago. She now heads up one of the ASX emerging high-grade manganese project, Accelerate Resources. Please make her welcome.
Thanks, Jerry. Glad to be here. Okay, at Accelerate, we aim to become the next high-grade manganese producer to supply the premium product to the EV battery space and the steelmaking industries. And on the screen, there are 5 reasons why you should invest in Accelerate. Number 1, manganese is a critical mineral, and it is a part of the solution to the green energy transition. And number 2, we're on our pathway to find the next Woody mine. which gonna be a high-grade premium product and a long mine life. Number 3, our business model is aiming for early cash flow, and that drives our exploration strategy and targeting near-surface high-grade deposits, and that will further fund to looking for deep-seated mineralizations. And then you also will invest in other high-grade premium and quality assets, such as Pilbara Lithium project, which we continue to work in the background. And the company is led by experienced and focused management team. So as Brandon just said that, why should you invest in manganese? And manganese is one of the commodities widely available, but it is also critical minerals. It helps to transition the global green energy transitions. There's no substitute to manganese in the steelmaking industry. And in addition to that, the long-term price forecast for the manganese price is positive and stable. With the 60% manganese supply coming from Africa and 60% of the demand coming from Asia, that's create a unique market opportunity for Accelerate Woody North project positioned in the East Pilbara. So on the screen is the showing the project location. It is the 150 kilometer east of Marble Bar. We have 30 kilometers to the national road. And that is currently the Woody mine is using that road to tow truck their mine product to the port headland. Just over 12 months ago, we picked up the project and consolidated our ground position in the area. So currently we have about just over 350 square kilometers of premium ground location. So in terms of the exploration potential, where we are is one of the most prospective ground in the Pilbara for the manganese. The area has been locked by the larger organizations and companies in the past, and the previous explorers who explored in the ground have been focused on the northern part of the project. So as you can see on the screen, to the south of us, about 70 kilometers is the Woody mine. We have the same geological units comparing to the Woody mine. And in the last 12 months since we consolidated the ground, we have conducted a LiDAR survey, field mapping sampling trip, and have completed the 2 rounds of drilling programs. All the data collected confirm that the Woody style mineralizations within our project area. So our goal is to find the next Woody mine. So Woody mine is a world-class deposit. It's operated since 1970s, has produced more than 35 million ton high-grade premium product. Currently, the JORC resource is sitting around 49 million ton at the 30.9%, and that is high grade. So we think we have the potential to find the next Woody, and here's why. So comparing to Woody mine corridor, we have the same geology, same northwest trending structures, and the same hydrothermal system. Double the strike length of the Woody mine corridor, and the only difference is the areas has been extremely underexplored and underdrilled. So in the last 12 months, as I said, we conducted 2 rounds of drilling. So the data showing on the screen on your left hand side is the confirmed near surface high grade potential. So this is a cross section from the Dales patch within area 42. Some high grade zones 7 meters at 24.6% from surface, 6 meters of 23.4% from surface, and 8 meters of at 30.8% manganese from 13 meters. And on the right-hand side is showing the deep-seated large-scale potential. So we have the discovery hole number 60. That's a drill down to 90 meters, multiple zone of mineralization, averaging 44 meters at 16%. So that shows the potential of a large mineralization below surface. So they are very encouraged by what we have drill tested back in 2012. And then in January, we went back and the team conducted the project-wide surveys. So as announced today, we have identified 5 large corridors within our project areas. And 2 of those large areas, being the Gum Creek and the Parsons Creek, has never been drilled. So showing the great exploration potentials. So those areas over 33 kilometers strike lengths that could hosting another woody type deposit. So moving forward, our exploration strategy for 2023 will be dual exploration strategies. So we will conduct about 10,000 meters of a drilling program, targeting both near surface high-grade DSO potential. Wanted to deliver the first maiden drill resources by end of the year, and at the same time, looking for big targets and the big price. So what confirms this product can produce premium products? So we have conducted a preliminary metallurgical test, and test results indicate that there is the product produced from our project area can generate premium DSO materials. And the dense media separation tests were done in 2010 also confirmed that medium grade material can benefit up to above 40%. So lots of news flows are coming through in the next 10 months. We believe this will transform the company. From March to June, we will systematically sampling the new corridors that we just announced today. And lots of drilling coming up, RC drilling program commencing. We will continue to conduct the high purity manganese test work and also progress to granting the leasing project in the Pilbara. Coming to the June to September quarter, second round of RC drilling and phase 2 high purity manganese test work. And we will conduct early stage end user test programs for the manganese product. And release the drilling result. So towards the end of the year, aiming to release the maiden resource statement, conducted diamond drilling programs and metallurgical test work. We'll initiate the initial conversations and discussions with our end users. So why invest in Accelerate? Number one, we're focused on manganese, and which is a critical mineral. In the tier 1 jurisdiction and close to infrastructure. Drilling is about to start, lots of news flow coming up, and we're aiming to deliver our maiden drop resource by end of the year. Our business model is early cash flow, targeting near surface DSO material, and also looking for large deposit potential with a big price. So thanks for listening, and if you have more questions, please come to the booth number 84. Thank you.
Thank you, Yaxi, and perfectly timed as well. Looking for copper exposure, but every project you look at is years away from producing with huge capital hurdles. Introducing the Kalamazoo Underground, a fully permitted project that has all processing infrastructure already in place and is only months away from first copper production. Here to bring you up to speed with what is arguably Australia's next copper mine is Hillgrove Resources MD Lachlan Wallace. Please make him welcome.
Thank you very much. So today I'm just going to be talking about the Kalamazoo project in South Australia, which is at the cusp of becoming Australia's next copper mine. The real plan for Hillgrove over the course of this year is to go from explorer, where we currently are now, into copper production, targeting that late this year or early next. For those that aren't aware, Kalamazoo is located just out of Adelaide. Was mined as a series of open pits from 2010 to 2020. During that period, it produced about 137,000 tonnes of copper, about 55,000 ounces of gold. Over the last 3 years, we've been drilling below the base of those pits to demonstrate a viable underground. And now we've recently put out a feasibility study, which throws off about $200 million in free cash post-tax for a very small capital build of only $26 million. And this really puts it as one of the lowest capital-intensive copper development projects anywhere in the world. The project's fully permitted. It has all of the infrastructure that require in place, including a $3.5 million per annum processing facility and a tailings dam, excellent community relationships. And as you can see, we've already started some of those underground works. Quick corporate snapshot. We have a market cap of $70 million, about $5 million in the tin at the start of the year, so EV $65 million. The only other things I want to bring your attention to on this slide is we have about $220 million worth of tax credits. So this obviously becomes quite valuable as we get into free cash flow generations from production, as well as $17 million worth of franking credits, which enables us to push out about $50 million worth of fully franked dividends. 50 kilometres out of Adelaide, we have excellent access to market, only 70 kilometres down Highway 1 to Port Adelaide. Excellent relationship with the community, but in addition to that, being based in the Adelaide Hills, it means that we can access a high quality workforce without some of the, concerns or restrictions that are facing many of the fly in, fly out companies. So we approach the community relationship on a genuine win-win basis. We've been held up in industry as best in, well, held up by government as best as industry with regards to our community relationships. You can see here a picture of another community award from the state premier at the time. We also fully have a sustainability report that we update on a yearly basis. So that's all mapped to the GRI framework. And we also mapped that to the UN Sustainable Development Goals and the ICMM. All infrastructure we need is on place, so 3.6 million tonne per annum process facility. We've maintained all the energy and water contracts. We're pumping water through the entire system on a daily basis. We're inching the mill, running the conveyor system, running all of the crushing system on a weekly basis. So we've maintained this in a position where it's ready to restart without any material type of refurbishment costs. We have all the critical spares you need on site, including mill motors, mill gearbox, spare trunnion, crusher swing stock, basically anything you need to get going, we have. So we're really positioned for a quick restart, have a permitted and operating tails facility. So the tails dam itself actually has around double the capacity of what our current mine plan has. So as we continue to drill, add a resource base in, we actually already have the permitting to be able to store the tailings dam in place. The pit itself is actually a very large asset in terms of providing us the ability to put the declines in at the base, access those loads very quickly. We have, as you saw on the first slide, already started some of those underground works. And what that has enabled us to do is put all the infrastructure at the base. So now down the bottom, we have ventilation, we have crib facilities, ablution, we've got our power, water, tag boards, everything that we need to get going. So basically on day one, we walk in, we're taking a 4.2 metre cut on the first day. Underground conditions are exceptionally good. You can see here, really competent rock mass. This just means that we can turn over these areas really quickly and get that production rate right up. And only 13 metres in, we're hitting the high-grade mineralisation and starting to stockpile that on the ROM. So 12 months ago, the first feasibility study came out. The high-level economics are on the wall there, but basically $200 million in free cash post-tax. We basically only have about 7 months to production. So pending the finalisation of funding, which should occur in the next couple of months, we'll have 2 months to mobilise in 7 months, and we're actually turning the mill on and producing first copper. With regards to the ore body, we're extremely well leveraged to the copper price. So our ore zone is really a high-grade core with a lower-grade halo. So all of our stopes at the moment, they really are terminating within mineralisation. So as copper price goes up, we've got the ability to basically just widen those stopes out and very quickly increase the amount of copper that we're feeding into the plant. And because the plant is only 40% utilised, we can do that without displacing any high-grade ore. So effectively just putting more metal into a higher price environment provides enormous leverage to a rising copper price. In addition to that, we have plenty of exploration upside as well. So last 3 years, we've drilled 122 holes. We've actually hit 143 intersections of basically economic grade and widths. This is over 100% strike rate. And each one of those drill programs has translated into an increase in resources. We had 1 million tonnes in 2019. We doubled that in 2020. We doubled that again in 2021. That's at the stage when we stopped, basically put out that initial plan, the $200 million free cash flow plan. But then since then, we've continued to drill. We've actually added another 21%, another 1.2 million tonnes to that resource base. And as that's brought into the plan, that'll grow accordingly. And all of that new information will come out over the course of the next month or so. And we're continuing to drill. So basically, every time we're drilling, we're hitting something. And every time that we're running a program, it's increasing. And that's really quite exciting when you consider that we've only actually drilled 2 of 9 known lode areas within the permitted lease. And both of those are open at depth and along strike. And they're really only limited by the amount of drilling. So they're called Kavanagh and Nugent, respectively. The areas that are within that initial mine plan are just highlighted there in the black box on the left-hand side. And we look at Kavanagh, so this is underneath the main pit there. It's had some really, really nice intercepts. We've had 170 meters, 1% copper, 0.3 grams per ton gold, 166 meters, 0.9. But these long sort of intersections, they're really sort of made up of multiple high-grade lodes in the order of 10 to 30 meters true width, about 1 to 3% copper equivalent. And they'll be the main focus of what we're chasing underground. What we have also done is drilled down about 250 meters below where we've cut the current mine plan off, and we're seeing the mineralization is still continuing. One of the deepest holes we have there is 3 meters, 1.1% copper, but a whopping 5 grams per ton gold. So excellent sort of intercepts to be able to follow up on. Nugent, the other area that's in the mine plan at the moment, was an area that was mined about 2015. You can see on the right-hand side is the open pit that was taken out. All the pink holes there, they're grade control holes over about 0.8% copper. The load or the model itself there is what's currently modeled. You can see the drilling over the past 12 months. That's all the yellow tags, the red dots there is expanding that size of that ore body out. So we're now up to a position where we've added another 6,000 copper metal tons into that, which is not currently in the plan. We'll bring that into the plan and release it out shortly. So in addition to, I guess, the depth and strike extensions of what's currently in the mine plan, we have another couple of areas we call South Hub and North Hub. So just firstly, South Hub, it's a collection of 3 areas. It's Emily Star, Critchley and Paringa. Emily Star, again, was a pit that was mined about 100 meters in depth, everything open at depth. And we're now starting to drill below that with the intent to get an initial resource out that we can then bring in as an additional work area to the mine plan and thereby increase the annual throughput through that latent capacity in the mill. Some of the deepest holes we've got there, sitting there at 17 meters, 3.6% copper, 0.6 grams per ton gold. So you're really nice intersects to be able to follow up on, drill down deeper and get a nice resource out. On the other side, we have North Hub, again, a collection of a couple of areas, Coopers and North Kavanagh. North Kavanagh itself is about 200 meters long in strike. We've drilled it down to about 100 meters in depth, fairly consistent, anywhere between 8 to 12 meters, 1.8 to 2% copper with about a half gram gold credit. And we only have one hole down deep at about 300 meters in depth. It's still continuing, 17 meters, 0.8% copper. So we have already started to drill that out, and those results will be coming out in the next week or so with regards to, again, establishing another resource area that we can bring into that initial work area or mine plan to establish another work area. And obviously, as we're establishing those work areas, we're bringing them in without any real change to the fixed cost, particularly on the processing and G&A side. So they're coming in at relatively low incremental costs, and we're able just to push more copper through that latent capacity in the mill, adding a heap of more value to the annual cash flows. So really exciting sort of period coming up over the next few months. Obviously, getting these drilling results out for North and South Hub I just spoke about. We're updating the mine plan to include some of that drilling for the last 12 months. That'll come out over the course of the next month. Fully expect to conclude the funding within the next month. And then after that, we'll be hitting our final investment decision. And then we start mining. And as I said, it's a very short period of time to mobilize and then get into that first copper production, really targeting late this year, early next for first copper, first revenue flows. And obviously, as we continue to drill, we'll also be doing the North Hub and South Hub resources and attempting to bring them into the mine plan to go from 2 work areas to 4 and really try and bring that annual throughput from about 15,000 tons of copper well up because the mill itself obviously has plenty of latent capacity. So look, in summary, it's a low capital near term copper play. It's got plenty of upside potential, both to copper price as well as exploration upside. It's fully permitted. It's got all the infrastructure that we need in place. And I think when you consider that, we're an EV of about $65 million, exceptional value opportunity. So if you want to learn any more, we're out in the booth. But thanks very much for your time.
Sarytogan Graphite Limited's Managing Director is Sean Gregory. He's a geologist and seasoned mining executive with more than 20 years' experience in minerals exploration, development, and mining. He joins us now with the Sarytogan story. Please make him welcome.
Thank you, Jerry. Yeah, it's my pleasure today to tell you about the Sarytogan graphite story located in central Kazakhstan. It is a giant project. In fact, it is the highest grade and the second largest of all JORC graphite projects anywhere in the world. Not only that, it's perfectly tailored to meet the battery metals product strategy that we've set for ourselves, and that's on the back of our premium microcrystalline sizing. We floated the company in July last year, and we've had some wonderful results since then. And by far the highlight of that was the progress that we made in the metallurgy. In fact, the breakthrough that we made in the metallurgy by achieving purity of 99.87% carbon, which is aligned with that battery strategy. I'll tell you today about Kazakhstan, a fabulous mining jurisdiction, one that we're very comfortable operating in, and in fact, one that we see as the biggest opportunity for the company to capitalise on that location between the major markets being Europe and China, and also an established mining jurisdiction. Now, the other thing that is, of course, an asset to our company is, of course, our people. And to do what we do in Kazakhstan, that's not something that can easily be done from here, but we do have an established team in country. We've got 6 geologists and 4 support staff in country, and they're progressing the approvals on this project and also progressing exploration across Kazakhstan. $5 million cash. As I mentioned, we IPO'd in July, and we've done very well since then, up around 40 cents from a 20-cent start. So let's just touch on Kazakhstan as a mining jurisdiction. It's actually the world's largest uranium producer. They do 40% of the world's uranium. It's number 12 and number 13 in mining and oil and gas, respectively. Their mining code is based off the West Australian Mining Act, which is one that I'm familiar with and gives me a lot of comfort. And it's also in a brilliant location geographically, right between the 2 largest battery markets being China and Europe, and indeed all connected by rail infrastructure. We can put our product in a sea container and send it east or west on that rail network at very affordable rates. It also offers a geopolitical alternative to China. China dominates graphite mining with 64% of the graphite mining and also the anode manufacturer. So we've got an opportunity to either leverage off that expertise or to actually displace some of that material into the European market. Now, zooming in, we're located central Kazakhstan. This is what I call this town of Karaganda. It's what I call the Kalgoorlie of Kazakhstan. It's got all of the support infrastructure we need. It's an established industrial hub. There's coal mines there, there's a big steel mill, and there's a workforce required to support that. Lots of infrastructure. Perhaps the highlight is 110 kilovolt power, only 2 kilometres from the project. Now, here is the project site itself, and what you'll see there is outcropping graphite mineralisation. As I mentioned, triple the grade of most graphite projects, outcropping, low strip, which gives us a big economic head start for our project. The mineral resource, as I mentioned, it's enormous, several hundred years of mine life here, and in fact, it's growing. We did 3,000 metres of HQ diamond drilling last year, targeted to increase the categorisation up to an indicated mineral resource, and that is on target for next month. We actually also drilled outside of the footprint, really to make sure that we're covering all bases, making sure we do find the best parts of the ore body to focus in on, and as a consequence of that, the resource will also grow. Very, very briefly, as you'd be well aware, graphite is always required in electric vehicle battery, regardless of what your cathode chemistry is. It's also forecast to be, of all the battery metals, the one that's got the strongest growth, with the market forecast by Benchmark Mineral Intelligence to go up 650%. Part of that is the transition away from synthetic graphite across to natural graphite, being a lower CO2 footprint. Synthetic graphite is made by baking petroleum coke at very high temperatures. Benchmark forecast that we need 97 new graphite mines by 2035. That's a lot of mines, but it's based on a small average mine size. And I'll let you do the numbers, but given the size of the deposit at Sarytogan, I pose the question, how many of those mines could be built at Sarytogan? Now, we'll dive now into the focus of our project, which is all around our product strategy and demonstrating progress towards that. Now, the first thing you'll learn about graphite as you dig into it is that coarse flake graphite is a good thing to have. It commands a premium price over fine graphite, and there's a lot of very good projects, especially in East Africa, progressing those projects, and they really look to maximise that coarse flake. Some of their byproduct is a very fine material that can then be upgraded into battery anode material, but you've got to go ultra fine. Our project, as it turns out, is actually down in that ultra fine space. And with the recent work that we've done, we have demonstrated a beautiful purity up to 99.87, which is well on the way to chasing down that growth market of batteries and that $3,000 a tonne price. The reason we can do that, of course, is because of our geology and our metallurgy. The material is very fine-grained in nature, and so we grind that material down and float it up. Now, the grinding, of course, that takes energy, but don't forget, our deposit being triple the grade of most other projects can afford to pay for triple the grinding to be net on that basis. So here's our process that we go through, starting with that exceptionally high-grade resource. We grind it, we float it up to the mid-80s, and then we move into the purification world. We've been able to demonstrate that both alkaline roasting and chemical purification using acids are both effective, and that's pretty standard technology across the graphite industry. And we've been able to demonstrate that we can get up to 99.87. The next step for us is to now take that to a bulk scale to be able to do the spheroidization step. So to get it into a battery, you need to be fine-grained, you need to get it up to those very high 99.9s, and then you need to spheroidize it to roll these graphite flakes up into cabbage-like balls so that you can pack as much graphite into a battery and get as much energy into that battery as you can. To do that, though, we need to bulk up our test work. Up until now, it's been at the bench scale, and we've awarded a contract to a facility in East Germany there, which is looks like a metallurgist's paradise there with everything you need to do what we need to do at the bulk scale. So we've sent them 240 kilos of material, and their first run, they'll generate 27 kilos of concentrate, which allows us to demonstrate that spheroidization. Lots of news flow. We all come to the RIU conference every year and debut our work program, and we're really pleased with this. We've got some really good consultants helping us. So first step is the mineral resource upgrade. Back in the IPO in July, we committed to do that in the current quarter, and we're on track to do that. We will do that next month in March, targeting that indicated classification. We're progressing that test work, as I mentioned, bulk flotation, spheroidization, and then we'll plug it into a battery and measure its characteristics. And in parallel, we're diving into a pre-feasibility study. So that'll be a finish-to-finish dependency there, where we'll complete both of those pieces of work at the same time. Our local team are progressing. They're progressing the land access and the approvals. And in fact, they're also doing some exploration. They've done a great job with Sarytogan, and we've said to them, well, if you can find Sarytogan, what else can you find in those old libraries in Kazakhstan full of Russian reports? Thank you very much for your attention, and we'll see you again soon.
During the coming year, Geopacific Resources will be striving to reinvigorate its advanced and prospective Woodlark Island gold project, building on a solid foundation of quality resources, past investment, and excellent ESG credentials. Interim CEO Richard Clayton joins us to provide an update on the company's plans to make 2023 a year of progress. Please welcome Richard Clayton.
Well, thank you very much for that kind introduction. And it's a real pleasure to be here speaking to you today on behalf of Geopacific Resources and able to talk to you about our Woodland Island Gold Project, which is located off the coast of PNG in the Milne Bay province. Those of you who are followers of our stock will be aware of the challenging year that 2022 posed for the company following the suspension of the project development roughly 12 to 13 months ago, and the subsequent period of business transformation activities that went on. But what I want to focus on today is the future. I want to talk about why we as a company are still firm believers in the potential of Woodlark, and also what steps we are planning to take over the coming year to realize the value that we see. So if we start off with the what and the why of Geopacific. We have a large, robust resource. With 1.5 million ounces, it's 94% of that is measured and indicated. And importantly, there's these near surface high grade zones, which we feel will provide optionality as we assess the project going forward. Many of these points we'll touch on further slides. We're fully permitted. We have a lot of very, very detailed and good quality work that's been done in the past, which we can leverage off in our future analysis of the project. We also conducted a strategic review last year where we had engagement with a number of parties and dialogue with potential development parties, partners are ongoing. There is a lot of exploration upside at Woodlark, which hasn't really been touched on. Our tenement package covers the majority of the island. And if we look at other peer islands, such as Lihir, Simberi, Mortimer, and so on, our currently discovered gold endowment is far smaller than what they have discovered there. What that points to me is that there remains undoubted potential on the island. An important factor is strong stakeholder support. We're operating on an island in close proximity to a community, so therefore our community relations, our relations with the various tiers of government, with the regulators, are a very important part of what we need to maintain and to progress as we continue to move the project forward. A key part of that, which again we'll touch on later, is the community relocation project. There were a number of, I think, 200 plus households lived within the mining lease, and we've been progressively moving those guys off that lease, which has brought us some near-term and some longer-term benefits as well. We, as a board, we are very focused on building a team to deliver a robust development plan for this project. We are looking at tiers in terms of what skill sets we need at CEO level, what skill sets we need at the board, and what skill sets we need at a sub-executive level, at a projects level, and we're actively engaged with sourcing the right people for those roles. So in 2022, we produced an updated resource estimate, and that was based on drilling which was undertaken during the year, and obviously the drilling that was available to us prior to that. One of the important parts of that drilling from our perspective was we actually drilled a trial grade control pattern, which was targeting some of the high grade zones of the Coolamadaw deposit. If we look at that cross section there, we can see where those high grade zones occurred. The competent person that we had, as is the ones with all these resource geologists, is a fairly conservative person and was looking to limit how far we spread some of those higher grades around. So what we're doing at the moment is that we're very focused on getting our geology team to go and re-look through there and on the controls and on the detailed geological information we have to give us more comfort in how we can join these high grade zones and demonstrate those continuity. The importance of those zones is that about 75% of our ounces is in 50% of our rock. So there is a lot of value is driven by these higher grade zones. And that's going to feed into these optimization studies and also is guiding our exploration targeting, which we'll touch on soon. But again, looking at that cross section, you can see how if you're focused more in on the higher grade, you can end up with smaller pits, which get a lot of the ounces, but at a considerably reduced strip. Our strip ratio here, based on our previous historical feasibility study, was relatively modest. It's in the 3s, sub 4, and clearly there's opportunity to have a very low strip project here. Exploration targeting. This is an ongoing project. We can see there on the map the ELs. again, a lot of the exploration targets that we have, they're walk-up targets. They've been limited exploration to date. Most of the work in the recent years has been focused on resource definition and drilling support of project development. That said, there's been a lot of geological work done over the years here, some good quality work, and we're currently going through that and compiling that and pulling that into an exploration targeting review. That, to complement the various studies we're going to go to, is that we're focusing in on where are these higher grade areas, leaning on the understanding we got from some of the close space drilling and the work we've done on the resource estimate in 2022. If quickly touch just on the island there, in the sense that a lot of it's covered by sedimentary cover. You can see fairly typically the prospects that have been found, including the main deposits, are the ones that stick out the ground on the exposed volcanics. There's clearly a lot of ground that has been barely touched, and so there's a lot of that potential remains, both in terms of within the mining lease, but also in the broader exploration licenses. Project optimization. So we're going to engage in a number of studies. It's important to recognize that there's a big body of detailed work which has been done, which we're leveraging off. We don't need to go and completely reinvent the wheel here. We're just looking at various aspects where we feel that we're able to focus in on trying to optimize the project with the aim of minimizing upfront capital and maximizing the grade. Three broad focuses. One is a stage development. As I said, a lot of the initial ounces are actually in what you may call the starter pits of the project. Is there an opportunity to stage it? Is there an opportunity for a smaller scale project? These are all things we're going to look at, give us smaller capital, potentially increase optionality, and a lower funding hurdle. Infrastructure is, being on the island, is quite an infrastructure heavy project. We're going to re-look at where that's located. It's capital versus operating cost trade-offs to a degree. It's working out areas where the foundations, ground conditions could be better. And it's also, we're going to be looking to try and leverage the existing infrastructure, which again may feed in with a stage project. And all of this comes with a focus on the higher grade, and then that is then going to be aligned with that exploration strategy. Community relocation. It's where community relations is obviously a huge thing for us, operating on an island in PNG, and we're blessed with a very, very solid community relations team, and we have good relationships and numbers both on the local level, provincial level, and the national level. A key part of that work is the relocation project, which I alluded to earlier. That's about 66% complete, and we're progressing that now on a self-build, low-cost approach. We've received lots of commendation about this from the PNG government, and then MRA did a site visit recently, which resulted in us getting an actual letter of commendation from them. This is a great benefit as it's opened up access to exploration areas within the ML, and it's also substantially de-risked the project. Just a brief overview of the work program that we're looking at, where we have parallel exploration targeting, potentially leading into exploration. And we also have the parallel optimization studies, both linked in with this focus on the higher grade areas. And also we have the community relocation program, which will continue on a self-build basis alongside that. Just returning to those investment highlights. Well, we have a advanced project with a lot of work to leverage off. We've got a robust resource with upside potential, strong stakeholder support, and the high grade that we know is there and that we demonstrated is there with the close space drilling is giving us some optionality, which we intend to target during the studies during the course of the year. So I think just about on time. Thank you very much. Appreciate your attention so late in the day. And thank you very much.
Noah's Rule has been providing independent debt and hedging advisory services to the mining industry for the past 18 years. As the industry embraces new world and green minerals and a range of other commodities not traditionally banked or hedged, And as sources of debt also expand and deepen, it's more important than ever that emerging mining companies can tap into an independent advisor that can help them understand their risk profile and bankability in order to match their aspirations with the appropriate funding parties. Here to explain further is Stephen Wray, Director of Debt Advisory for Noah's Rule. Please make him welcome.
Thanks, Jerry, and thanks everyone in the room and online for sticking it out. Appreciate that. So, dude, where's my debt? Look, I'm not suggesting anyone in the industry is represented by any characters in this B-grade cult movie from the year 2000, but just like the characters in the movie, it can often feel like you're stumbling around looking for something that's a little bit elusive and maybe not fully understanding what you were looking for nor how to get there. I guess the free ad for us is it's our job to direct you through that. So who are we? We grew out of hedging advice and execution, but have a fully fledged debt advisory service as well. We're not just the hedging people. Our principals, Dave Rowe and Sean Russo, will be known to many, and Sean is here somewhere in the room today. Myself, I've got a background in project finance, and as an age reference, I can track back to funding IGO into their acquisition of the Long Nickel project. So really out of this slide, the $3 billion of debt advisory work is typically made up of sort of 100 million-ish sort of licks, typically and unashamedly focused at the people in this room and at this conference. And truth be known, our creed is really, we like doing good work for good people. So we've done a lot of execution, obviously commodity and advisory work. The interesting piece is our fees are skewed to the back end of the project. They're skewed to the client's discretion, and we don't get paid until after the work is done. So we back ourselves in to give you a fairly good result, and we're rewarded that way. And our creed is we don't believe you can prudently look at debt in isolation without considering the risk and the options to manage that risk from a price perspective. Given we are considered by others to be experts in this field, we think that gives us a distinct advantage. So some of these are a little bit old, but really I hope they show the depth and breadth of our customer size and commodities. Currently, on a debt advisory basis, we have 2 or 3 roles, a couple in Australia across various states and commodities, and one in North America. Some are new project developments, and others are expansion of existing operations. And we're very proud to say that, you know, over a decade ago, Perseus and Panost and such companies sat in the room, this very room, as pre-production explorers and formed a relationship with us. So we helped them out with their initial debt advisory work. And those relationships still continue today. Others have been taken over, other customers have been taken over, merged, people move. So we cross-pollinate amongst companies and relationships. So we're absolutely set up to support companies as you transition from explorer to developer and then to becoming a producer. That's enough about us. The sort of backdrop to debt funding markets is this is not new. Everyone understands the cost pressures in place for the industry. Simply put, it's very difficult to develop a greenfields project, notwithstanding there may be debt capital available. The nature and the mix of that debt capital is ever changing. Layered levels of debts that we're seeing now bring capital and potentially longer tenor and relaxed terms, but they also bring increased complexity, intercreditor agreements being required, as well as complexity in the borrower's ability to structure proper and thoughtful risk protection strategies. Sometimes those strategies aren't even allowed in the financing. So, you know, the caution here is easier to obtain sort of less restrictive debt is great at the start, but history would tend to show that those providers are less accommodating if things wobble. Some observation from a debt funding markets point of view. In general, look, we can say there's an abundance of cash being invested, chasing yield around the world, but the flow to the resource sector, I think, frankly, has been very spotty and very commodity dependent. For instance, people around the world will invest in the wind farm, which is infrastructure, but they won't invest in the supply of the raw materials to make that wind farm, which is interesting to think about. But alternative sources of capital are now available, as never been greater either. be that debt capital or equity or quasi-equity. But there are headwinds. Someone mentioned earlier gold is a bit on the nose. Well, we're certainly seeing gold is less popular with some financiers, and that's around the whole ESG context. Some just won't do single asset gold projects anymore. So that really brings into question and focus, I guess, the need for borrowers to fully understand the risks that are associated with their project and be fully ready when approaching the right targeted debt providers. I mean, we've seen examples of companies who aren't quite ready, go to market with a debt advisor, might go to 10 or 13 banks, and unsurprisingly, most of those say no. I mean, if you're a contractor and you knew you were one of 13 being asked to tender, it might change the way you respond to people. So we became involved and did a bit of work with that company and went to the 4 banks that we thought could actually deliver such a transaction, and we ended up closing a three bank deal. So it just doesn't make sense to us. To risk your project and how it's thought of in the marketplace being non-bankable by the scattergun approach. You really need to be targeted and know what it is that you want. In a debt funding context, specifically for banks, the general observation we'd make here is there are basically less banks prepared to lend to the sector. Minimum debt sizes are increasing, as well as the preferred borrower size or their market cap. There's a general appetite, obviously, to finance green commodity projects, but it needs to be recognised that some of these commodities may not be hedgeable at this point in time, and banks will naturally gravitate towards the larger scale projects, larger scale sponsors. Mandatory hedging to support debt facilities will be required, and not all banks execute that hedging, depending on the commodity. So that capability should be a consideration in bank selection. And also, when you're thinking about your debt you need, banks will obviously assume their own price deck. It's internally generated and based on their own in-house sort of economic assumptions, etc. Depending on the bank, they might be reviewed once or twice a year. And particularly in times when prices rise quite dramatically, those sort of price assumptions can be sort of 25% away from market. So that clearly impacts on the ability of the project to carry a debt in terms of the financier's eyes. From a non-bank perspective, it's a big, deep market here. And interesting on the first line, OEMs, who would have thought that it'd ever be in there as funding mining companies, right? But non-bank providers will often be prepared to lend smaller amounts or lend earlier than the banks. They'll also give weight to expansion plans in the future that perhaps the banks won't. And it's fair to say that in the industry, it wasn't that long ago that if a project was funded by offtake financing, everyone else thought that the project wasn't bankable. Well, that's not the case now in any shape or form. These arrangements can be flexible. Sorry, excuse me. These arrangements can be flexible and certainly a viable alternative source of debt capital. We see the emergence of agencies like NAIF and EFA potentially filling that void between equity and traditional debt. It's longer term debt at commercial bank rates, which is nice. Certainly to date, the agencies are less concerned for now in lending to non-hedgeable commodities. We just urge some caution to borrowers. You need to fully understand the attaching price risks in such a structure. By their nature, things like offtake finance and metal streaming arrangements, they're anti-dilutive to shareholders, obviously at the start, but will be revenue subtractive when mines are in production. And those providers might not be too concerned about your price risk as they're driven by the commodity supply. But we suggest that while you owe them any money whatsoever, you should probably be concerned about your price risk. Now, clearly, because I'm from Noah's Rule, I'm not going to give a talk without talking about hedging. But in the context of single asset companies, our view is you should never speak about getting debt for your project without considering the risks of price movements. Too many times we see that everyone pushes back the so-called hedging talk until the very end. And by then, it's probably too late. You're already locked into your funding arrangements You're likely to have less negotiation room for volume, pricing, etc. and structure. Excuse me. So if you remember only one thing from my talk today, perhaps apart from the title, please remember that the earlier you have the hedging talk, the better off you will be from a structural debt sizing and pricing cost perspective. And to summarise this slide, really, I think the key consideration for any company is the balance between the amount of hedging completed compared to the impact of or dilution of the required equity levels. In other words, the ultimate cost of hedging over the life of the loan or the hedge must be measured against the value of the early pre-production equity dilution that is avoided. Importantly, any hedging undertaken should be structured to enhance the probability of repaying your debt. So the flip side of hedging is, of course, no hedging, but we would like to think there is an intelligent and nuanced discussion to be had to help you determine what you, as the producer, where you want to sit on the risk-reward matrix. In essence, the no hedging position, if you think about it, kicks the equity risk question down the road. It may never be encountered, which obviously is great, but the downside risks are heightened. We are not so sure that every investor buys shares in a gold company for exposure to the gold price. So, where is my debt? Well, to summarise all this, and it's obviously very high level, sort of 10-minute summary, you just need to be clear and clarify the company's commercial and financial objectives, understand the key issues of importance to all stakeholders, and determine the expectations, corporate objectives, and aspirations of the company. If you don't have a clear idea of what you want and what you don't want, you run the risk of lenders and, frankly, advisors just taking a cookie cutter approach. So work out the debt carrying capacity of the project. Use recently observed price decks, banking ratios that have been seen in transactions, but be cognizant of the market risks inherent in the financing. What levels of equity are required and the impact of using different hedging strategies. So this debt capacity analysis should assist you in finalising a financing strategy that you can then, in a targeted manner, take to financiers that best suit your desired outcomes. And be completely transparent. If you understand your project, then you will understand where the pressure points are, or where the points of pain are, as we like to call them. Don't be afraid to disclose them to financiers, because they don't like surprises. But when you disclose them, also disclose your thoughtful risk mitigation strategies for dealing with these issues. And finally, I'll leave you with this cartoonal anecdote, which kind of neatly reflects our thinking within Noah's Rule. Obviously, we're going to be there at drinks, so happy to have a chat. But if you need anything at any time, happy to chat with you, reach out and make contact. Thanks for your time.
Thank you very much. And that brings us to the end of our conference. Thank you to the AV team at the back of the room. Give them a round of applause, Shane and the rest of the team. And that's it from me. And that's it from me on a permanent basis as I head off to retirement. I dread the prospect, but that's the way it is. All right, ladies and gentlemen, see you.